This is going to be a video over June the 2nd. So overall, strong bull trend day, formed a wedge bottom early in the day and rallied for the rest of the day. Daily chart, the bulls have been fighting over, they want a measured move up, which takes you to up here, which I think ultimately you will get there. This looks like a trading range. And trading range is usually closed gaps. When you break above this, it sells off, closes this gap. You break below this, fills the gap. Break below it, fills the gap. This is all trading range. Higher time frame charts, I think will trigger this buy. And bears are probably disappointed here, but the problem that the bulls have is that's a weak buy signal bar, and this is the strongest buy climax, consecutive buy climaxes in since 2008, which makes me think the market's going to go more sideways here. You know, look how long the market went sideways here during this expanding triangle from 18 all the way to 20. And even if you go further back, I don't want to do that, but everyone's seen the Dow Jones. It went sideways for several years, around early 2000s, 2008. So we may do this for several years. But back to the 5 minute. So the bulls had a trend line break on the prior day. We tested off, sold off at the end of the day. I mean, at the beginning of today, formed a wedge bottom and had a strong rally. Overall with the day, whenever you have a strong rally with this many bull bars, it's basically a surprise. It's a major surprise breakout, or call it a major breakout, whatever you want. The point is, it's probably going to have a strong enough influence for the rest of the day. You know, look here. There's one bear bar out of 9 or 10 bull bars here. And then, to take that even further, there's two bodies that close below their midpoints out of this many bull bars. Which means, that's another strong trend. Signs of a strong breakout. You want to see consecutive bull bars, consecutive trend bars that are closing above their midpoints in a bull trend or below their midpoints in a bear trend. So, overall, most important piece with this day is don't sell after this. Don't sell below bars. It's very difficult to sell above bars. Even selling here, scaling in. Traders barely made money. They probably got trapped. Same thing here, same thing here. It's very difficult. And the reason for that is traders are buying every pullback they get. They're buying, 10 points from the high, 20 points from the high. And they're buying a couple points above the moving average, expecting price not to get to the moving average. Strong breakout, buy 50%. Strong breakout, try and buy a couple points above this gap. Buy below this low, buy below this low, scaling lower. Buy the close, buy above it, buy more lower. And they're just buying like crazy. If you ever have trouble with the trend day, look at the SDS. It's an inverse of the day. And you can see we had trend line break and a rally, 3 pushes up. 1, 2, 3. Tried to break the downside, broke above the wedge, and now it's 3 pushes up here. Strong, decent sell signal bar for the high of the day. And we just sold off with only 2 small dojis and the rest of the bars closing below their midpoints. Very strong, probably going lower. And, I think people have naturally an upward bias. Because for a lot of people, I think they would say, when you look at this chart, it's harder to sell in a tight bear channel than it is to buy a strong bull trend. And the reason for that is what I just said. People naturally have an upward bias. It's easier for people to see this is a strong bull trend. And for some people, they have that difficulty. Others, they don't. So it's important to practice back and forth. And you can actually, for any market, you can actually, if you want to make an inverse chart, what I would do is I would just make these bars, instead of white, make them black, kind of like this, and then make the down bars white. And I would just take a screenshot of this and flip the chart upside down. So I would take a screenshot, I would flip it upside down. So now if we just pretend like this is upside down, and then I would take the left side of the chart, drag it to the far right, and that would create an inverse. That would basically create this chart. The SDS is just an inverse of it, so it's easier to see. But you're not going to buy here. Too many bear bars down. You're not going to buy there. You're not going to buy here. You might get out of shorts, but it's not a good buy. Not a good buy here. Big bull bar, but breaking above. Haven't touched moving average several bars. You're not going to buy that. Similar to, where was it? Yesterday. Yeah, similar to up here. Strong breakout. Probably going to get a couple legs up. Not going to sell here. Not going to sell after 2 strong bull bars. Weak doji, not going to sell there. Traders are not going to sell there after 4 bull bars. They may sell this high and scale in. Second entry buy, they may sell that for a scalp, but they'll probably be disappointed. Traders that sold, scalped out, which is why we tested back to the entry price, tested back to the high up here, got a second leg down. So anyways, I don't want to, I have to make this video a little quick, and I don't want to talk too much about the inverse, but comment on any questions you have and I'll answer it. Let me just do a quick bar by bar. So the bulls, 3 consecutive, well, let me do it over here. Here's the start of the day. Couple dojis, sign of a trading range open, tight channel down, first reversal up may fail. Weak buy signal bar, probably sellers above, but again, I don't want to be selling down here. And the pullback could be pretty deep. We could close this gap, so I don't necessarily want to be selling up here. So it's an inside bar, possible final flag. We could break out to the upside. We could break out and turn down. You know, probably an okay buy if you can scale in lower, but you need to stop probably below here. Better if you can buy more down here. Couldn't trigger the buy and broke to the downside and called a low 2 short, low 1 short. Doesn't really matter. It's final flag. Probably going to break to the downside and reverse up. And disappointment. Bulls who bought the close, scaled in. Disappointed here, getting out. More importantly, it's tight trading range. Inside bars, and boom, big bull bar. Closing the gap up here, but as soon as we closed that gap, we instantly found sellers. So it's kind of a second leg trap. It's hard to see, but leg 1, pullback, leg 2. And closed the gap and immediately found sellers. So it's important to remember in a trading range, you don't want to buy. Trading ranges often have vacuums that test. Here, let me back up. Trading ranges often have vacuums that test resistance. So where's resistance? Well, the upper portion, upper 1/3 resistance. There's all sorts of areas. There's a measured move of the initial range. We didn't get that. So a lot of traders, you know, would bulls have bought if price went above this bar? Maybe. But that's why it's important to wait for follow through. So if you did buy, you get out below that bar. Too much risk of a bear breakout below. Strong bear bar, closing at the low, maybe just under. The low was 75, the close was 75, so it's at the low. And then we get reversal. So now you have a wedge bottom, 1, 2, 3, and a break below the wedge bottom, creating a larger wedge, 1, 2, 3. To break out below this, it's a double bottom here, and that makes it a credible buy. Two strong bear bars, so, you know, is it a 50-50 chance that you fall below the bar and reverse up? Could be, but it's an okay buy. Weak follow through bar, weak entry bar, testing up here, so bear sold, scalped out, we're back at that entry price. Some bears will sell, stop up here, hoping that we channel down. I would not do that. I think this is too much risk of a bottom. So far, not clearly always in long though. 3 consecutive bull bars. Bulls probably will give up above that bar. Might be always in long, but just under the moving average. You know, if you buy below, it's a swing buy, betting that we test up. Maybe we'll test up here. Probably we'll test this close. And another thing to point out, this is a trading range. This is a reasonable buy if you can manage the trade well. So it's not terrible to buy this close. It's just difficult if you buy this close, put your stop down here, you get stopped out, or worse, you buy the close, put your stop down here, and you get stopped out. If you can't get back in, that's a problem. And you also have to think about the risk reward. So if you're buying, stop up here, going for here, that's an issue. But if I was to buy the close, use a really wide stop, buy more above a bull bar here, well, where's break even? If I'm so disappointed by the trade, maybe I just get out break even there, which we're not quite there. But then maybe I see a third bull bar and I think, well, gee, maybe this will be the low. Maybe I'll hold and we'll probably test up to here. And that was also some of the break even bulls. Rallying, very tight bull channel, probably always in long. Tested this close, broke above it. So now we're trying to break above a possible double bottom here. Here's the neckline. And that's a lot of bull bars. So if you're buying, buy the close, still buy the close. Maybe you have a stop 5 points below, maybe 5 points below a bar. Bull breakout, 5 points below the bar. Maybe your stop's here. And you just keep trailing. First bear bar after several bars. This is a strong enough bull breakout that you're probably going to get a measured move of some sort. Maybe something like that. And for the sake of time, we already got that measured move, but we ended up getting this. And really for the rest of the day, it's just traders will buy, they'll take profits, buy more lower, strong breakout, bigger stop, buy 50% pullback. Maybe you'll get 2 legs down. That was the second leg. They'll buy there, they'll buy there, they'll buy there, here even, here. Really you could buy here and put a stop down here, and if you scale in, you'll probably make money. So you could buy there, buy more lower, stop somewhere down here, you made money. Some bulls will they'll buy, new breakout, move their stop, new breakout, move their stop down here. New breakout, move the stop, and maybe new breakout here, move your stop here. At some point, you have to argue it's trading range, and moving your stop below higher lows is not as effective as selling at new highs, taking profits. But either way, very strong trend, important to buy. And if you're ever looking at this, last thing I'll say about this day, if you're ever looking at this and thinking, I want to buy, but the stop's too far, and therefore I want to buy a pullback. That is a sign that you're in a small pullback bull trend or a strong breakout, and you need to buy. If you're looking at this and saying, gee, this is getting pretty strong, but I don't want to put a stop down here. I want to buy a pullback. That you have to kind of see that as, if you're thinking that, everybody's thinking that. Therefore, it's the same logic here. The stop's far away. I want to sell a pullback here, but I'm not getting one. Well, you have to sell, and you have to use a wide stop. See if there's anything else to mention. And the last thing is, there's going to be a lot of wedges. Wedge 1, 2, 3, 1, 2, 3. Triangle here. Another wedge 1, 2, 3, or 1, 2, 3, 1, 2, 3. Parabolic wedge, 1, pullback 2, pullback 3, 1, 2, 3. Point is, strong trends always form wedges, and it's important not to sell all the wedges, because you're gonna, it's an easy way to take a lot of really small losses that add up to a big loss. Hope this video helps.